Hello, everyone. Thank you so much for joining us for another weekly wrap-up. My name is Jeremy Kronemeyer, Operations Manager for Wickham Financial Group, and I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what's going on in the markets?
Hey, thank you, Jeremy. Thanks for our listeners jumping on a call. Yeah, it was all about Middle East and the conflict, geopolitical events. So really with oil, that shot up about 35%. And generally, we just saw risk assets globally, that volatility just increase. But here with our indices, we saw the Nasdaq down about 1%, the S&P 500 down about 2%. And if we look globally to the developed market and the emerging markets, they were down about 7%. So on the commodity front, we saw gold down about 2.3. And the biggest reason why is the dollar shot up. That's going to bring down commodities, as well as silver was down as much as 10%. And crude oil, that did the opposite direction, as you know, that shot up about 35%. So we saw the U.S. dollar and the yield. The U.S. dollar rallied sharply, putting that pressure on those international stocks, the commodity. And then the U.S. Treasury yields rose on the anticipation of higher inflation because of the commodity increase for energy, the energy prices. If we look at U.S. economic data, we had the jobs number come out. So we saw non-farm payrolls unexpectedly showed about a 92,000 job loss in February. Now, the unemployment rate did tick up for that to about 4.4%. We saw retail sales for January decline about 0.2 month over month. That was missing some expectations. And business activity, that ISM manufacturing number that came in at 52.4, the ISM service jumped to about 56.1. Tariffs. The Treasury Secretary Bessent signaled a likelihood of increasing global tariffs to about 15% using that Section 122. If we look at international markets, so going overseas, not necessarily what's going on in the Middle East here with Iran, but we look at the Eurozone. Inflation rose on the CPI number. That was about 1.9% year over year. So that core was about 2.4. We saw UK's bond yield surge amid some doubling in gas prices, putting some pressure with some bond yields, inflationary fears over there. We also saw Australia's Q4 2025 growth accelerated. Then in China, we saw the manufacturing and service, their PMIs, they stayed in contractionary territory, still contracting. So the week ahead, it's really going to be dominated headlines, geopolitical, what's going on with the Iraq war, the escalation of it, what effect that's going to have on energy prices, really what effect could that have in the overall inflation, and then next steps, how could that affect the Fed's decision going forward? But if we're looking at supply risk with energy, Qatar's energy minister warned that producers may need to declare force majeure, potentially shutting down some production. We saw oil and gas prices both climb significantly higher, as we mentioned earlier, about 35%. Now, how will that affect the Fed? I think they're going to have a bit of a dilemma here. We got a lower weak payroll that could imply maybe some slower growth, but at the same time, we have higher inflation because of energy and the conflict going on overseas. Now, we look at some key U.S. economic data that'll be coming out. We'll get the February CPI on Wednesday. We'll be looking at the January PCE price index. Both are expected to remain pretty steady, but at a level still high for the Fed, meaning they want to bring it down for inflation reasons, so on and so forth. But we'll have the 10 and 30-year Treasury auction coming out. Housing indicators will be reported. Some second estimate on the Q4 2025 GDP numbers and some preliminary consumer sentiment readings. We'll get some earnings out. We'll actually have Oracle reporting Tuesday evening. And then wrap it up with some international data from China. We're looking at some inflation numbers. And then the monthly GDP figures from the UK. Jeremy?
Well, Graham, you had mentioned the Iran conflict a couple times. Do you see if that is prolonged, how is that going to affect the markets and the investments?
Well, I think the key is the depth and the length, right? Prolonged. If we were seeing a protracted prolonged, which I guess in more modern times, they generally aren't. But if we do, I think that's higher potential inflation, definitely on the energy, trickling into affecting earnings, affecting the consumer, so on and so forth, which I think negatively affects economic growth, probably negatively affecting stocks. But if we can kind of get out of this quicker, that'd be less of an effect on earnings, less on inflation, less on the consumer. Doesn't mean we still won't have some volatility. We could certainly see the markets go through even more volatility here, but I think that would be probably best case scenario from an economic standpoint if we can kind of shorten this thing up, kind of limit the effect. Unfortunately, I don't know what that would look like, right? We don't have that crystal ball. I would just say you're probably going to hang out there a little longer than initially thought. Doesn't mean necessarily the bombs are dropping and things are exploding per se. And I'm not trying to make light of that, but it might just be the overall stress, the unclear nature of what direction, the tension that's still going to be out there that might keep commodity costs higher. So meaning in certain areas, inflation might just be stubbornly higher than what we originally thought pre-war.
Got it. Well, Graham, we always appreciate the information and expertise, and thank you to our listeners that kind of check in with us every single week, and we look forward to seeing you next time. Have a good week.
Take care.